Berkshire Hathaway Incorporated, 1997, Chairman's Letter. To the shareholders of Berkshire Hathaway Incorporated, our gain in net worth during 1997 was $8.0 billion, which increased the per share book value of both our Class A and Class B stock by 34.1%. Over the last 33 years, that is since the present management took over, per share book value has grown from $19 to $25,488, a rate of 24.1% compounded annually. All figures used in this report apply to Berkshire's A shares to successors to the only stock that the company had outstanding before 1996. The B shares of economic interest equal to 1/30th that of the A. Given our gain of 34.1%, it's tempting to declare victory and move on, but last year's performance was no great triumph. Any investor can chalk up large returns when stocks soar, as they did in 1997. In a bull market, one must avoid the refrain duck that quacks boastfully after a torrential storm, thinking that his paddling skills have caused it to rise in the world. A right-thinking duck would instead compare its position after the downpour to the other ducks on the pond. So what's our duck rating for 1997? The table we're facing, the page shows that though we paddled furiously last year, passive ducks that simply invested in the S&P index rose almost as fast as we did. Our appraisal of 1997's performance then quack. When the market booms, we tend to suffer in comparison with the S&P index. The index bears no tax costs, nor do mutual funds, since they pass through all tax liabilities to their owners. Last year, on the other hand, Berkshire paid or accrued $4.2 billion for federal income tax, or about 18% of our beginning net worth. Berkshire will always have corporate taxes to pay, which means it needs to overcome their drag in order to justify its existence. Obviously, Charlie Munger, Berkshire's vice chairman and my partner, and I won't be able to lick that handicap every year, but we expect over time to maintain a modest advantage over the index, and that is the yardstick against which you should measure us. We will not ask you to adopt the philosophy of Chicago Cubs fan who reacted to a string of lackluster seasons by saying, "Why get upset? Everyone has a bad century now and then." Gains in book value are, of course, not the bottom line at Berkshire. What truly counts are gains in per share intrinsic business value. Ordinarily, though, the two measures tend to move roughly in tandem in 1997. That was the case, led by a blowout performance at Geico. Berkshire's intrinsic value, which far exceeds book value, grew at nearly the same pace as book value. For more explanation of the term intrinsic value, you may wish to refer to our owner's manual, reprinted on pages 62 to 71. This manual sets forth our unrelated business principles information that is important to all of Berkshire shareholders. In our last two annual reports, we furnished you a table that Charlie and I believe is central to estimating Berkshire's intrinsic value. In the updated version of that table, which follows, we trace our two key components of value. The first column lists our per share ownership of investments, including cash and equivalents, and the second column shows our per share earnings from Berkshire's operating business before tax and purchase accounting adjustment, discussed on pages 69 and 70. But after all interest and corporate expenses, the second column excludes all dividends, interest, and capital gains that we realized from the investment presented in the first column. In effect, the columns show what Berkshire would look like. It's split into two parts, with one entity holding our investment and the other operating all our business, bearing all corporate costs. Year 1967, 1977, 1987, 1997. Investments per share, $41, $372, $39,010, $38,043. Pre-tax earnings per share excluding all from investments, $1.09, $12.45, $108.14, $717.82. Pundits will ignore what our 38,000 employees contribute to the company, instead simply view Berkshire as a de facto investment company. Should study the figures in the second column. We made our first business acquisition in 1967, and since then, our pre-tax operating earnings have grown from $1 million to $888 million. Furthermore, as noted in this exercise, we have assigned all of Berkshire's corporate expenses overhead of $6.6 million, interest of $66.9 million, shareholder contributions of $15.4 million to our business operations. Even though a portion of these could just as well have been assigned to the investment side, here are growth rates of the two segments by decade. Pre-tax earnings per share excluding all income from investment, decade ending investment per share. Decade ending 1977, 1987, 1997. Investments per share 24.6%, 26.5%, 25.5%, 27.6%, 24.1%, 20.8%. Annual growth rate, 1967, 1997, 25.6%, 24.2%. During 1997, both parts of our business grew as a satisfactory rate, with investment increasing by $9,543 per share, or 33.5%, and operating earnings growing by $296.43 per share, or 70.3%. On one important caveat: because we were lucky in our super cat insurance business, to be discussed later, and because Geico's underwriting gain was well above what we can expect in most years, our 1997 operating earnings were much better than we anticipated, and also more than we expect for 1988. Our rate of progress in both investments and operations is certain to fall in the future. For anyone deploying capital, nothing recedes like success. My own history makes the point. Back in 1951, when I was attending Brent Graham's class at Columbia, an idea giving me a $10,000 gain improved my investment performance for the year by a full 100 percentage points. Today, an idea producing a $500 million pre-tax profit for Berkshire adds 1 percentage point to our performance. It's no wonder that my annual results in 1950s were better by nearly 30 percentage points than my annual gains in any subsequent decade. Charlie's experience was similar. We weren't smarter, then just smaller. At our present size, any performance superiority we achieve will be minor. We will be helped, however, with the fact that the business to which we have already allocated capital, both operating subsidiaries and companies in which we are passive investors, have splendid long-term prospects. We are also blessed with a managerial core that is unsurpassed in ability and focus. Most of these executives are wealthy and do not need the pay they receive from Berkshire to maintain their way of life. They're motivated by the joy of accomplishment, not by fame or fortune. Though we are delighted with what we own, we are not pleased with our prospects for committing incoming funds. Prices are high for both business and stocks. Does not mean about the prices either will fall. We have absolutely no view on that matter, but it does mean that we get relatively little in prospective earnings when we commit fresh money. Under these circumstances, we try to exert a Ted Williams kind of discipline. In his book, The Science of Hitting, Ted explains that he carved the strike zone into 77 cells, each the size of a baseball, swinging only at a ball in his best. Best cell he knew would allow him to bat .400, reaching for balls in his worst spot. The low outside corner of the strike zone would reduce him to .230. In other words, waiting for the fat pitch would mean a trip to the Hall of Fame. Swinging indiscriminately would mean a ticket to the minors. If they're in the strike zone at all, the business pitches we now see are just catching the lower outside corner. If we swing, we will be locked until low returns, but if we let off the day's balls go, by there can be no assurance that the next ones we see will be more to our liking. Perhaps the attractive prices of the past were the aberrations, not the full prices of today. Unlike Ted, we can't be called out if we resist 3 pitches that are barely in the striking zone. Nevertheless, just standing there day after day with my bat on my shoulder is not my idea of fun. Unconventional commitments. When we can't find our favorite commitments, a well-run and sensibly priced business with fine economics, we usually opt to put new money into very short instruments of the highest quality. Sometimes, however, we venture elsewhere. Obviously, we believe that the alternative commitments we make are more likely to result in profit than loss, but we also realize that they do not offer the certainty of profit that exists in a wonderful business secured at an attractive price. Finding that kind of opportunity, we know that we are going to make money, the only question being when, with alternative investments, we think that we are going to make money. But we also recognize that we will sometimes realize losses, occasionally of substantial size. We had 3 non-traditional positions at the year-end. The first was derivative contracts for 14.0 million barrels of oil, that being what was then left of a 45.7 million barrel position we established in 1994 to 1995. Contracts for 31.7 million barrels were settled in 1995 to 97, and these supplied us with a pre-tax gain of about $61.9 million. Our remaining contracts expired during 1998 and 1999. And these, we had an unrealized gain of $11.6 million at year-end. Accounting rules require that commodity positions be carried at market value. For both our annual and quarterly financial statements reflect any unrealized gain or loss in these contracts. When we established our contracts, oil for future delivery seemed modestly underpriced today, though we have no opinion as to its attractiveness. Our second non-traditional commitment is in silver. Last year, we purchased 111.2 million ounces mark to market. That position produced a pre-tax gain of $97.4 million for us in 1997. In a way, this is a return to the past for me. 30 years ago, I bought silver because I anticipated its demonetization by the U.S. government. Ever since, I have followed the metals fundamentals but not owned it. In recent years, bullion inventories have fallen materially, and last summer, Charlie and I concluded that a higher price would be needed to establish equilibrium between supply and demand. Inflation expectations, it should be noted, play no part in our calculation of silver's value. Finally, our largest non-traditional position at year-end was $4.6 billion at amortized cost of long-term zero-coupon obligations of the U.S. Treasury. These securities pay no interest. Instead, they provide their holders a return by the way of discount at which they are purchased, a characteristic that makes their market prices move rapidly when interest rates change. If rates rise, you lose heavily with zeros, and if rates fall, you make outside gains. Since rates fell in 1987, we ended the year with an unrealized pre-tax gain of $598.8 million in our zeros. Because we carry the securities at market value, that gain is reflected in year-end book value. In purchasing zeros rather than staying with cash equivalents, we risk looking very foolish. A macro-based commitment such as this, however, has close to 100% probability of being successful. However, you pay Charlie and me to use our best judgment not to avoid embarrassment. We will occasionally make an unconventional move when we believe the odds favor to it. Try to think kindly of us when we blow one. Along with President Clinton, we will be feeling your pain. The Munger family has more than 90% of its net worth in Berkshire, and the Buffetts more than 99%. How we think about market fluctuations. A short quiz. If you plan to eat hamburgers throughout your life and are not a cattle producer, should you wish for higher or lower prices for beef? Likewise, if you are going to buy a car from time to time but not an auto manufacturer, should you prefer higher or lower car prices? These questions, of course, answer themselves. But now for the final exam. If you expect a net saver during the next 5 years, you should hope for a higher or lower stock market during that period. Many investors get this one wrong, even though they are going to be net buyers of stocks for many years to come. They're elated when stock price rise and depressed when they fall. In effect, they rejoice because prices have risen from the hamburgers. They will soon be buying. This reaction makes no sense. Only those who will be sellers of equities in the near future should be happy at seeing stocks price. Prospective purchasers should much prefer sinking prices. For shareholders of Berkshire who do not expect to sell, the choice is even clearer. To begin with, their owners are automatically saving even if they spend every dime they personally earn. Berkshire saves for them by retaining all earnings thereafter, using these savings to purchase business and securities. Clearly, the more cheaply we make these buys, the more profitable our owners' indirect savings program will be. Furthermore, through Berkshire, you own major positions in companies that consistently repurchase their shares. The benefits that these programs supply grow as prices fall. When stock prices are low, the funds that an investee spends on repurchase increases our ownership of that company by a greater amount than is the case when the prices are higher. For example, the repurchases at Coca-Cola, the Washington Post, and Wells Fargo made in past years at very low prices benefited Berkshire far more than do today's repurchases made at loftier prices. At the end of the year, about 97% of Berkshire shares are held by the same investors who owned them at the start of the year. That makes them savers. They should therefore rejoice when markets decline and allow both of us, our investees, to deploy funds more advantageously. So smile when you read the headline that says investors lose and the market fails. Had it in your mind to disinvestors loses, market falls, but investors gain. Though the writers often forget this truism, there is a buyer for every seller, and what hurts one necessarily helps the other. As they hit in golf matches, every putt makes someone happy. We gained enormously from the low prices placed on many equities in the business in the 1970s, 1980s. Markets that were then hostile investment transients were friendly to those taking up permanent residence in recent years. The actions we took in those decades have been validated, but we have found new opportunities in its role as corporate saver. Berkshire continually looks for ways to sensibly deploy capital, but it may be some time before we find opportunities that get us truly excited. Insurance operations overview. What does excite us, however, is our insurance business. Geico is flying. We expect that it will continue to do so. Before we expound on that, though, let's discuss float and how to measure its cost. Unless you understand the subject, it will be impossible for you to make an informed judgment about Berkshire's intrinsic value. To begin with, float is money we hold but don't own. In an insurance operation, float arises because premiums are received before losses or paid in an interval that sometimes extend over many years. During that time, the insurer invests the money. Typically, this pleasant activity carries, which is the downside. The premiums that an insurer takes and usually do not cover the losses and expenses it eventually must pay. That leaves it running an underwriting loss, which is the cost of float over time is less than the cost of the company would otherwise incur to obtain funds. But the business is a lemon if its cost of float is higher than market rates for money. A caution is appropriate here because the loss cost must be estimated. Insurers have enormous latitude in figuring their underwriting results, and that makes it very difficult for investors to calculate a company's true cost of float. Estimating errors, usually innocent but sometimes not, can be huge. The consequence of these miscalculations flow directly into earnings. An experienced observer can usually detect large-scale errors in reserving, but the general public can typically do no more than accept what's presented. And at times, I've been amazed by the numbers that big-name auditors have implicitly blessed. As for Berkshire, Charlie and I attempt to be conservative in presenting its underwriting results to you because we have found that virtually all surprises in insurance are unpleasant ones. As the numbers in the following table shows, Berkshire Insurance Business has been a huge winner. For the table, we have calculated our float, which we generate in large amounts relative to our premium volume, by adding net loss reserves, loss adjustment reserves, funds held under insurance, assumed and unearned premium reserves, and then subtracting agents, balances, prepaid acquisitions, cost, prepaid tax, and deferred changes applicable to assumed reinsurance. Our cost of float is determined by our underwriting loss or profit. In those years when we have an underwriting profit, such as the last 5 years, our cost of float has been negative. In effect, we have been paid for holding money. 1. Underwriting loss. 2. Average float, approximate cost of funds, year-end yield on long-term government bonds. In million dollars, ratio of 1 to 2. 1967, profit 17.3, less than 0. 5.50%. 1968, profit 19.9, less than 0. 5.90%. 1969, profit 23.4, less than 0. 6.79%. 1970, $0.37, 32.4, 1.14%, 6.25%. 1971, profit 52.5, less than 0, 5.81%. 1972, profit 69.5, less than 0, 5.82%. 1973, profit 73.3, less than 0, 7.27%. 1974, 7.36, 17.1, 9.30%, 8.13%. 1975, 11.35, 87.6, 12.96%, 8.3%. 1976, profit 102.6, less than 0, 7.30%. 1977, profit 139.0, less than 0, 7.97%. 1978, profit 190.4, less than 0, 8.93%. 1979, profit 227.3, less than 0, 10.8%. 1980 profit 237.0, less than 0, 11.94%. 1981 profit 228.4, less than 0, 13.61%. 1982 1.56, 220.6, 9.77%, 10.64%. 1983, 33.87, 231.3, 14.64%, 11.84%. 1984, 48.6, 253.2, 18.98%, 11.58%. 1985, 44.23, 90.2, 11.34%, 9.34%. 1986, 55.84, 797.5, 7.00%, 7.60%. 1987, 55.43, 1,266.7, 4.38%, 8.95%. 1988, 11.08, 1,497.7, 0.74%, 9%. 1989, 24.40, 1,541.3, 1.58%, 7.97%. 1990, 26.65, 1,637.3, 1.63%, 8.24%. 1991, 119.59, 1,895.0, 6.31%, 7.40%. 1992, 108.96, 2,290.4, 4.76%, 7.39%. 1993, profit, 2,624.7, less than 0, 6.35%. 1994, profit, 3,056.6, less than 0, 7.88%. 1995, profit, 3,607.2, less than 0, 5.95%. 1996, profit, 6,702.0, less than 0, 6.64%. 1997, profit, 7,093.1, less than 0, 5.92%. Since 1967, when we entered the insurance business, our float has grown at an annual compounded rate of 21.7%. Better yet, it has cost us nothing and in fact has made us money. Therein lies an accounting irony. Though our float is shown on our balance sheet as a liability, it has had a value to Berkshire greater than an equal amount of net worth would have had. The expiration of several large contracts will cause our float to decline during the first quarter of 1998, but we expect to grow substantially over the long term. We also believe that our cost of float will continue to be highly favorable. Super Cat Insurance. Occasionally, however, the cost of our float will spike severely. That will occur because of our heavy involvement in the Super Cat business, which by its nature is the most volatile of all insurance lines. In this operation, we sell policies that insurance and reinsurance companies purchase in order to limit their losses when mega catastrophes strike. Berkshire is the preferred market for sophisticated buyers. When the big one hits, the financial strength of Super Cat writers will be tested, and Berkshire has no peer in this respect. Since truly major catastrophes are rare occurrences, our Super Cat business can be expected to show large profits in most years and to record a huge loss occasionally. In other words, the attractiveness of our Super Cat business will take a great many years to measure. What you must understand, however, is that a truly terrible year in the Super Cat business is not a possibility. It's a certainty. The only conscious is when it will come. Last year, we were very lucky in our Super Cat operation. The world suffered into catastrophes that caused huge amounts of insured damage, so virtually all premiums that we received dropped to the bottom line. This pleasant result has a dark side, however. Many investors who are innocent, meaning that they rely on representation of salespeople rather than on underwriting knowledge of their own, have come to their insurance business by means of purchasing pieces of paper that are called catastrophe bonds. The second word in this term, though, is an Orwellian misnomer. A true bond obliges the issuer to pay these bonds. In effect, are contracts that lay a provisional promise to pay on the purchaser. This convoluted arrangement came into being because the promoters with contracts wish to circumvent laws that prohibit the writing of insurance by entities that haven't been licensed by the state. A side benefit for the promoter is that calling the insurance contract a bond may also cause unsophisticated buyers to assume that these instruments involve far less risk than is actually the case. Truly outsized risk will exist in these contracts if they are not properly priced. A pernicious aspect of catastrophe insurance, however, makes it likely that mispricing even of a severe variety will not be discovered for a very long time. Consider, for example, the odds of throwing a 12 with a pair of dice, 1 out of 36. Now assume that the dice will be thrown once a year, that you, the bond buyer, agree to pay $50 million if a 12 appears, and that for insuring this risk, you take in an annual premium of $1 million. That would mean you had significantly underpriced the risk. Nevertheless, you could go along for years thinking you were making money. Indeed, easy money. There is actually a 75.4% probability that you would go for a decade without paying out a dime. Eventually, however, you would go broke. In this dice examples, the odds are easy to figure. Calculations involving monster hurricanes and earthquakes are necessary necessarily much fuzzier, and the best we can do at Berkshire is to estimate a range of possibilities for such events. The lack of precise data coupled with the rarity of such catastrophes plays into the hands of promoters who typically employ an expert to advise the potential bond buyer about the probability of losses. The expert puts some money on the table. Instead, he received an upfront payment that is forever his, no matter how inaccurate his predictions. Surprise! When the stakes are high, an expert can invariably be found who will affirm, to return to our example, that the chance of rolling at 12 is not 1 in 36, but more likely 1 in 100. In fairness, we should add that the expert will probably believe that his odds are correct, a fact that makes him less reprehensible but more dangerous. The influx of investor money into catastrophe bonds, which may well live up to their name, has caused supercat prices to deteriorate materially. Therefore, we will write less business in 1998. We have some large multi-year contracts in the force, however, that will mitigate the drop. The largest of these are two policies that we described in last year's report, one covering hurricanes in Florida and the other signed with the California Earthquake Authority covering earthquakes in the state. Our worst case loss remains about $600 million after tax, the maximum we could lose under the CAA policy. Though this loss potential may sound large, it is only about 1% of Berkshire's market value. And indeed, if we can get appropriate prices, we would be willing to significantly increase our worst case exposure. Our supercat business was developed from scratch by Ajit Jain, who was a contributor to Berkshire's success in a variety of other ways as well. Ajit possesses both the discipline to walk away from business that is inadequately priced and this imagination to then find other opportunities. Quite simply, he is one of Berkshire's major assets. Ajit would have been a star in whatever career he chose. Fortunately for us, he enjoys insurance. Insurance Geico. 1-800-555-2756 and other primary operations. Last year, I wrote about Geico's Tony Nicely and his terrific management skill. If I had known then what he had in store for us in 1997, I would have searched for still greater superlatives. Tony, now 54, has been with Geico for 36 years and last year was his best. As CEO, he has transmitted vision, energy, enthusiasm to all members of the Geico family, raising their sights from what has been achieved to what can be achieved. We measure Geico's performance by first, the net increase in its voluntary auto policies, that is not including policies sustained by the state, and second, the profitability of the seasoned auto business, meaning policies that have been with us for more than a year and are thus past the period in which acquisition cost caused them to be money losers in 1996. In-force business grew 10%, and I told you how pleased I was since that rate was well above anything we had seen in 2 decades. Then in 1997, growth jumped to 16%, below the new business and in-force figures for the last 5 years. New voluntary auto years 1993, 1994, 1995, 1996, 1997. Auto policy 354,882, 396,217, 461,608, 617,669, 913,176. Policies in force 2,011,055, 2,147,549, 2,310,037, 2,543,699, 2,949,439. Of course, any insurance can grow rapidly if it gets careless about underwriting. Geico's underwriting profit for the year, though, was 8.1% of premiums, far above its average. Indeed, that percentage was higher than we wish it to be. Our goal is to pass on most of the benefits of our low-cost operation to our customers, holding ourselves to about 4% underwriting profit. With that in mind, we reduced our average rates a bit during 1997 and may well cut them against this year. Our rate changes varied, of course, depending on the policyholder and where he lives. We strive to charge a rate that properly reflects the loss expectancy of each driver. Geico is not the only auto insurer obtaining favorable results these days. Last year, the industry recorded profits that were far better than it anticipated or can sustain intensified competition. We'll soon squeeze margins very significantly, but this is development we welcome. Long-term, a tough market helps the low-cost operator, which is what we are and intend to remain. Last year, I told you about the record 16.9% profit-sharing contribution that Geico's associates had earned and explained that its two simple variables set the amount policy growth and profitability of seasoned business. I further explained that 1996 performance was so extraordinary that we had to enlarge the chart delineating the possible payouts. The new configuration didn't make it through 1997. We enlarged the chart's boundaries again and awarded our 10,500 associates a profit-sharing contribution amounting to 26.9% of their base compensation, or $71 million. In addition, the same two variables, policy growth and profitability of seasoned business, determined the cash bonuses that we paid to dozens of top executives, started with Tony. At Geico, we are paying in a way that makes sense for both our owners and our managers. We distribute merit badges, not lottery tickets. In none of Berkshire subsidiaries do we relate compensation to our stock price, which our associates can affect in any meaningful way. Instead, we tie bonus to each unit's business performance, which is the direct bonus of the unit's people. With that performance as terrific as it has been at Geico, there is nothing Charlie and I enjoy more than writing a big check. Geico's underwriting profitability will probably fall in 1998, but the company's growth could accelerate. We're planning to step on the gas. Geico's marketing expenditures this year will top $100 million, up 50% from 1997. Our market share today is only 3%, a level of penetration that should increase dramatically In the next decade, the auto insurance industry is huge. It does about $115 billion of volume annually, and there are tens of millions of drivers who would save substantial money by switching to us. In the 1995 report, I described the enormous debt that you and I owe to Lorimer Davidson. On a Saturday early in 1951, he patiently explained the ins and outs of both Geico and its industry to me. A 20-year-old stranger who'd arrived at Geico's headquarters uninvited and unannounced. Davey later became the company's CEO and has remained my friend and teacher for 47 years. The huge rewards that Geico has heaped on Berkshire would not have materialized had it not been for his generosity and wisdom. Indeed, had I not met Davey, I might never have grown to understand the whole field of insurance, which over the years has played such a key part in Berkshire's success. Davey turned 95 last year, and it's difficult for him to travel. Nevertheless, Tony and I hope that we can persuade him to attend our annual meeting so that our shareholders can properly thank him for the important contributions to Berkshire. Wish us luck. Though they're, of course, far smaller than Geico or other primary insurance operations, certain result last year than aggregate were fully stunning. National Indemnity's traditional business had an underwriting profit of 32.9% and, as usual, developed a large amount of float compared to premium volume. Over the last 3 years, this segment of our business run by Don Worster has had profit of 24.3%. Our homestead operation managed by Rod Eldred recorded an underwriting profit of 14.1%, even though it continued to absorb the expense of geographical expansion. Rod's 3-year record is an amazing 15.1%. Berkshire's workers' compensation business run out of California by Brett Kinsler had a modest underwriting loss in a difficult environment. Its 3-year underwriting record is a positive 1.5%. John Kizer at Central States Indemnity set a new volume record while generating good underwriting earnings. At Kansas Banker Surety, Don Toll more than lived up to the high expectations we had when we purchased the company in 1996. In aggregate, these 5 operations recorded an underwriting profit of 15.0%. The 2 Dons, along with Rod, Brad, and John, have created significant value for Berkshire, and we believe there is more to come. Sources of reported earnings. The table that follows shows the main sources of Berkshire's reported earnings. In this presentation, purchase accounting adjustment are not assigned to the specific business to which they apply, but are instead aggregated and shown separately. This procedure lets you view the earnings of our business as they would have been reported had we not purchased them. For the reasons discussed on page 69 and 70, this form presentation seems to us to be more useful to investors and managers than one utilizing generally accepted accounting principles, GAAP, which require purchase premiums to be charged off business by business. The total earnings we show in the table are, of course, identical to the GAAP total in our audited financial statements in millions. Pre-tax earnings, 1997-1996, operating earnings, insurance group, underwriting, supercat, underwriting, other insurance underwriting, Geico, underwriting, other primary, net investment income, Buffalo News, finance businesses, flight safety, $283, $555.2, $280.7, $52.9, $882.3, $55.9, $28.1, $139.5, $167, $174.8, $171.4, $58.5, $726.2, $50.4, $23.1, $3.1. Berkshire share of net earnings after taxes, minority interest. 1997, $182.7, $100.1, $181.1, $34.1, $703.6, $32.7, $18.0, $84.4, 1996, $107.4, $112.4, $110.2, $37.6, $593.1, $29.5, $14.9, $1.9. Home furnishing, jewelry, Scott Fester, including finance operations, East Candies, Shrew Group, purchase accounting adjustment, interest expense, shareholders designated contributions, other operating earnings, capital gains for investment, total earnings, all entities. 56.8, 31.6, 118.9, 58.6, 48.8, 104.9, 106.6, 15.4, 60.7, 1,715.7, 1,111.9, $2,827.6. 43.8, 27.8, 121.7, 51.9, 61.6, 75.7, 94.3, 13.3, 73.0, 1,221.4, 2,484.5, 3,705.9, 32.2, 18.3, 773, 35.0, 32.2, 97.0, 67.1, 9.9, 37.0, 1,194.5, 707.1, 24.8, 16.1, 81.6, 30.8, 41.1, 70.5, 56.6, 8.5, 42.5, 183.1, 1,605.5, 2,488.6. One from date of acquisition, December 23, December 23, 1996 includes Star Furniture from July 1, 1997. Excludes interest expense of finance. Business overall or operating business continue to perform exceptionally well, far from outdoing their industry norms. We're particularly pleased that profits improved at Helzberg's after a disappointing 1996 Jeff comment. Helzberg's CEO took decisive steps early in 1997 that enabled the company to gain real momentum by the crucial Christmas season. In the early part of the year, as well, sales remained strong. Casual observers may not appreciate just how extraordinary the performance many of our business has been. If the earnings history of, say, Buffalo News or Scott Festers compared to the records of their publicly owned peers, their performance might seem to have been exceptional. But most public companies retain 2/3 or more of their earnings to fund their corporate growth. In contrast, those Berkshire subsidiaries have paid 100% of their earnings to us, their parent company, to fund their growth. In effect, the records of the public companies reflect the cumulative benefits of their earnings they have retained, while the records of our operating subsidiaries get no such boost. Over time, however, the earnings these subsidiaries have distributed have created truly huge amounts of earning power. Elsewhere in Berkshire, the new season Scott Fester have alone paid us $1.8 billion, which we have gained employed elsewhere. We owe their managements our gratitude for much more than the earnings that are detailed in the table. Additional information about our various businesses is given on pages 36 to 50, where you will also find our segment earnings reported on a GAAP basis. In addition, on pages 55 to 61, we have rearranged Berkshire's financial data into 4 segments of a non-GAAP basis, a presentation that corresponds to the way Charlie and I think about the company. Our intent is to supply you with the financial information that we would wish you to give us if our positions were reversed. Look-through earnings. Reported earnings are a poor measure of economic progress of Berkshire, in part because the numbers shown in the table presented earlier include only the dividends we receive from investees. Though these dividends typically represent only a small fraction of the earnings attributable to our ownership, not that we mind the division of money, since no balance we regard the distributed earnings of investees as more valuable to us than the portion paid out. The reason is simple. Our investees often have the opportunity to reinvest earnings at high rates of return, so why should we want them to pay it out? To depict something closer to economic reality that Berkshire reported earnings, though, we employ the concept of look-through earnings as we calculate these. They consist of 1, the operating earnings reported in the previous section, plus 2, our share of the retained operating earnings of major investees that under GAAP accounting are not reflected in our profits. Less 3. Allowance for the tax that would be paid by Berkshire if these retained earnings of investees had instead been distributed to us. When tabulating operating earnings, here we exclude purchase accounting adjustments as well capital gains and other major non-recurring items. The following table sets forth our 1997 look-through earnings, though I warn you that the figures can be no more approximate since they are based on a number of judgment calls. The dividends paid to us by these investees have been included in the operating earnings itemized on page 11, mostly under insurance group. Investment income. 1, does not include shares allocable to minority interest. 2, calculate an average ownership for the year. 3, tax rate uses 14%, which is the rate Berkshire pays on dividends it receives. Acquisition of 1997. In 1997, we acquired Star Furniture International Dairy Queen, a deal that closed early in 1998. Both businesses fully meet our criteria. They are understandable, possess excellent economics, and are run by outstanding people. The Star transaction has an interesting history. Whenever we buy into an industry whose leading participants are known to me, I always ask our new partners, are there any more at home like you? Upon our purchase of Nebraska Furniture Mart in 1983, therefore, the Blumkin family told me about 3 outstanding furniture retailers in other parts of the country at that time. However, none was for sale. Many years later, Irv Blumkin learned that Bill Child, CEO of R.C. Wiley, one of the recommended 3, might be interested in merging, and we promptly made a deal described in the 1995 report. We have been delighted with that association. Bill is a perfect partner. Furthermore, when we asked Bill about the industry standouts, he came up with the remaining two names given by the Blumkins, one of these being Star Furniture of Houston, but time went by without being any indication that either of the two was available. On the Thursday before last year's annual meeting, however, Bob Demon of Salomon told me that Melvin Wells, the longtime controlling shareholder and CEO of Star, wanted to talk. At our invitation, Melvin came to the meeting and spent his time in Omaha, confirming his positive feelings about Berkshire. I meanwhile looked at Star's financials and liked what I saw. A few days later, Melvin and I met in New York and made a deal in a single 2-hour session, as was the case with the Blumkins and Bill Child. I had no need to check leases, work out employment contracts. I knew I was dealing with a man of integrity, and that's what counted. Though the Wolf family's association with Star dates back to 1924, the business struggled until Melvin and sister Shirley Tuman took over in 1962. Today, Star operates 12 stores, 10 in Houston and 1 each in Austin and Bryan, and will soon move to San Antonio as well. We won't be surprised if Star is many times its present size a decade from now. Here's a story illustrating what Melvin and Shirley are like. When they told their associates to sale, they also announced that Star would make make large special payments to those who had helped them succeed, and then define that group as everyone in the business. Under the terms of our deal, it was Melvin and Shirley's money, not ours, that funded this distribution. Charlie and I love it when we become partners with people who behave like that. The Star transaction closed on July 1. In the months since, we've watched Star's already excellent sales and earnings growth accelerate further. Melvin and Shirley will be at the annual meeting, and I hope that you get a chance to meet them. Next acquisition, International Dairy Queen. There are 5,792 Dairy Queen stores operating in 23 countries, all but a handful run by franchises, and in addition, IDQ franchises, 49 Orange Jollies operations in 43 caramel corn operations in 190 locations. Treat centers provide some combinations of three products. For many years, IDQ had a bumpy history. Then in 1970, a monopolist group led by John Moody and Rudy Luther took control. The new managers inherited a jumble of different franchising agreements along with some unwise financing arrangement had left the company in a precarious condition. In the years that followed, management rationalized the operation, extended food service to many more locations, and generally built a strong organization. Last summer, Mr. Luther died, which meant his estate needed to sell stock. A year earlier, Dick Hiphart of William Blair and Company had introduced me to John Moody and Mike Sullivan, IDQ CEO, and I had been impressed with both men. So when we got the chance to merge with IDQ, we offered a proposition patterned on our flight safety acquisition, extending selling shareholders the option of choosing either cash or Berkshire shares, having a slightly lower immediate value by tilting the considerateness we did. We encouraged holders to opt for cash, the type of payment we by far prefer, even then only 4.5% of IDQ shares elected cash. Charlie and I bring the modicum of product expertise to this transaction. He has been patronizing the Dairy Queens in Cass Lake and Bemidji, Minnesota for decades and have been a regular in Omaha. We have put our money where our mouth is. A confession. I've mentioned that I would strongly prefer to use cash rather than Berkshire stock in acquisition. A study of the record will tell you why. If you aggregate all of our stock-only mergers, excluding those we did with two affiliated companies, Diversified Retailing and Blue Chip Stamps, you will find that our shareholders are slightly worse off than they would have been had I not done the transactions. Though it hurts me to say it, when I've issued stock, I've cost you money. Be clear about one thing. This cost has not occurred because we were misled in any way by sellers or because they either after failed to manage with diligence and skill. On the contrary, the sellers were completely candid when we were negotiating our deals and have been energetic and effective ever since. Instead, our problem has been that we own a truly marvelous collection of businesses, which means that trading away a portion of them for something new almost never makes sense. When we issue shares in a merger, we reduce your ownership in all of our businesses, partly owned companies such as Coca-Cola, Gillette, and American Express, and all of our terrific operating companies as well. An example from sports will illustrate the difficulty we face. For a baseball team, acquiring a player who can be expected to bat .350 is almost always a wonderful event, except when the team was traded up .380 hitter to make the deal. Because our roster is filled with .380 hitters, we have tried to pay cash for acquisition, and here our record has been far better. Starting with National Indemnity in 1967 and continuing with, among others, Seas Buffalo News, Scott Fester, and Geico, we have acquired for cash a number of large businesses that have performed incredibly well since we bought them. These acquisitions have delivered Berkshire tremendous value, indeed far more than anticipated when we made our purchases. We believe that it is almost impossible for us to trade up from our present business and management. Our situation is the opposite of Camelot's Mordred, of whom Guinevere commented, "The one thing that I can say for him is that he is bound to marry well. Everybody is above him. Marrying well is extremely difficult for Berkshire. So we can be sure Charlie and I will be very reluctant to issue shares in the future in those cases when we simply must do so. When certain shareholders of desirable equity insist on getting stock, we will include an attractive cash option in order to attempt as many of the sellers to take cash as possible. Merging with public companies represents a special problem for us. If we are to offer any premium to acquiree, one of two conditions must be present. Either our own stock must be overvalued relative to the acquirees, or two companies together must be expected to earn more than they would if operated separately. Historically, Berkshire has seldom been overvalued in this market. Moreover, undervalued acquirers are almost impossible to find. That other possibility, synergy gains, is usually unrealistic. Since we expect acquirees to operate after we've bought them just as they did before, joining with Berkshire does not normally raise their revenues nor cut their costs. Indeed, their reported costs, but not their true ones, will rise after they are bought by Berkshire if the acquiree has been granting options as part of its compensation packages. In these cases, earnings of the acquiree have been overstated because they have followed the standard, but in our view, dead wrong accounting practice of ignoring the cost of the business of issuing options. When Berkshire acquires an option issuing company, we promptly substitute a cash compensation plan having economic value equivalent that of the previous option plan. The acquirer's true compensation cost is thereby brought out the closest in charge as it should be against earnings. The reasoning that Berkshire applies to the merger of public companies should be the calculus for all buyers. Paying a takeover premium does not make sense for any acquirer unless A, its stock is overvalued relative to the acquirers, or B, The two comprised will earn more combined than they would separately. Predictably, acquirers normally hew to the second argument because very few were willing to acknowledge that their stock is overvalued. However, voracious buyers, the ones that issue shares as fast as they can print them, are tacitly conceding that point, often also the running Wall Street version of a chain letter scheme. In some mergers, there are truly major synergies, though oftentimes the required payers too much to obtain them, but other times the cost and revenue benefits that are projected prove illusory. Of one thing, however, to be certain if a CEO is enthused about a particularly foolish acquisition, both its internal staff and its outside advisors will come up with whatever projections are needed to justify his stance. Only in fairy tales are emperors told that they are naked. It's common stock investment. Below we present our common stock investment, those with a market value of more than $750 million itemized. Shares, company, 1231 cost, dollars, market, dollars in millions, 97. American Express Company, 49,456,900, 2,000,000 to 1,563,414, 3,977,600, 48,000,000, 23,733,198, 1,727,765, 6,690,218. American Express Company, the Coca-Cola Company, the Walt Disney Company, Freddie Mac, the Gillette Company, Travelers Group Incorporated, the Washington Post Company, Wells Fargo Company, and others total common stocks. 1,392,700, 1,298.9, 381.2, 329.4, 600, 604.4, 10.6, 412.6, 2,177.1, 7,106.9, 4,414, 13.337.5, 2,134.8, 2,683.1, 4,821.0, 1,278.6, 840.6, 2,270.9, 4,467.2, 36,247.7 represents tax basis cost, which is aggregate is $1.8 billion less than the GAAP cost. We made net sales during the year that amounted to about 5% of our beginning portfolio. In these, we significantly reduced a few of our holdings that are below the $750 million threshold for itemization, and we also modestly trimmed a few of the larger positions that we detail. Some of the sales we made during 1997 were aimed at changing our bond stock ratio moderately in response to the relative values that we saw in each market. A realignment we have continued in 1998. Our reported positions, we should add, sometimes reflect the investment decisions of Geico's Lou Simpson. Lou independently runs an equity portfolio of nearly $2 billion that may at times overlap the portfolio that I manage, and occasionally he makes moves that differ from mine. Though we don't attempt to predict the movements of the stock market, we do try in a very rough way to value it. At the normal meeting last year with the Dow at 7,071 and long-term treasury yields at 6.89%, Charlie and I stated that we did not consider the market overvalued if one, interest rates remained where they were or fell, and American business continued to earn remarkable returns on equity that it had recently recorded. So far, interest rates have fallen. That's the one record is satisfied, and returns on equity still remain exceptionally high. If they stay there, and if interest rates hold near recent levels, there's no reason to think of stocks as generally overvalued. On the other hand, returns on equity are not a sure thing to remain at or even near their present levels. In the summer of 1979, when equities looked cheap to me, I wrote a Forbes article entitled, "You Pay a Very High Price in the Stock Market for Cheery Consensus." At that time, skepticism and disappointment revealed my point was that investors should be glad of the fact, since pessimism drives down prices to truly attractive levels. Now, however, we have a very cheery consensus. Does that not necessarily mean this is the wrong time to buy stocks? Corporate America is now earning far more money than it was just a few years ago. In the presence of lower interest rates, every dollar of earnings becomes more valuable. Today's price levels, though, have materially eroded the margin of safety that Ben Graham identified as a cornerstone of intelligent investing. In last year's annual report, I discussed Coca-Cola, our largest holding. Coke continues to increase its market dominance throughout the world, but tragically, it has lost the leader responsible for its outstanding performance. Roberto Goizueta, Coke CEO since 1981, died in October. After his death, I read every one of the more than 100 letters and notes he had written me during the past 9 years. Those messages could well serve as a guidebook for success in both business and life. In these communications, Roberto displayed a brilliant and clear strategic vision that was always aimed at advancing the well-being of Coke shareholders. Roberto knew where he was leading the company, how he was going to get there, and why his path made the most sense for his owners. And equally important, he had a burning sense of urgency about reaching his goals. An excerpt from one handwritten note he sent to me illustrates his mindset. By the way, I have told Olguita that what she refers to an obsession, you call focus. I like your term much better. Like all who knew Roberto, I will miss him enormously. Consistent with his concern for the company, Roberto prepared for a seamless succession long before it seemed necessary. Roberto knew that Doug Ivester was the right man to take over the work with Doug over the years to ensure that no momentum would be lost when the time for change arrived. The Coca-Cola company will be the same steamroller under Doug as it was under Roberto. Convertible preferreds. 2 years ago, I gave you an update on the 5 convertible preferreds that we purchased through private placements in 1987 to 1991 period. At the time of the earlier report, we had realized a small profit in the sale of our Champion International holding. The 4 remaining preferred commitments included 2 Gillette and First Empire State that we had converted into common stock in which we had large unrealized gains, and 2 others, US Air and Solomon, that had been trouble-prone. At times, the last 2 had me mouthing a line from a country song, "How can you miss if you won't go away?" Since I delivered that report, all 4 holdings have grown significantly in value. The common stocks of both Gillette and First Empire have risen substantially in line with the company's excellent performance. A year that $600 million we put into Gillette in 1989 had appreciated to $4.8 billion, and the $40 million we committed to First Empire in 1991 had risen to $236 million. Our 2 laggards, meanwhile, have come to life in a very major way. A transaction that finally rewarded its long-suffering shareholders. Salomon recently merged into Travelers Group. All of Berkshire shareholders, including me, very personally owe a huge debt to Derek Mawin and Bob Denham for first playing key roles in saving Salomon from extinction following its 1991 scandal, and second, restoring the vitality of the company to a level that made an attractive acquisition for Travelers. I've often said that I wish to work with the executives that I like, trust, and admire. No 2 fit the description better than Derek and Bob. Berkshire's final result from its Salomon investment will be tallied for some time, but it is safe to say that they will be far better than I anticipated 2 years ago. Looking back, I think my Salomon experience as having been both fascinating and instructional, though for the time in 1991 and 92, I felt like the drama critic who wrote, "I would have enjoyed the play except that I had an unfortunate seat. It faced the stage." The resuscitation of U.S. Airways, Borders, and the Miraculous. Those who have watched my moves in this investment know that I have compiled a record this embellished by success. I was wrong in originally purchasing the stock, and I was wrong later in repeatedly trying to unload our holdings at 50 cents on the dollar. 2 changes at the company coincided with its remarkable rebound. Charlie and I left the board of directors, and 2, Stephen Wolf became CEO. Fortunately for our egos, the second event was the key. Stephen Wolf's accomplishments in the airline have been phenomenal. There's still much to do at U.S. Airways, but survival is no longer an issue. Consequently, the company made up the dividend arrearages on our preferred during 1997, adding extra payments to compensate us for the delay we suffered. The company's common stock furthermore has risen from a low of $4 to a recent high of $73. Our preferred has been called for redemption on March 15, but the rise in the company's stock has given our conversion rights, which we thought worthless not long ago, great value. It is now almost certain that our U.S. Airways shares will produce a decent profit. That is, if my cost for Malux is excluded, the gain could even prove indecent. Next time I make a big dumb decision, Berkshire shareholders will know what to do. Phone Mr. Wolf. In addition to the convertible preferreds, we purchased 1 other private placement in 1991, $300 million of American Express perks. The security was essentially a common stock that featured a trade-off in its first 3 years. We received extra dividend payments during that period, but we were also capped in the price appreciation we could realize. Despite the cap, this holding has proved extraordinarily profitable thanks to a move by our chairman that combined luck and skill. 1 to 10% luck, the balance skill. Our perks were due to convert into common stock in August 1994, and the month before, I was mulling whether to sell upon conversion. One reason to hold was Amex outstanding survey. Harvey Golub, who seemed likely to maximize whatever potential the company had as a position that has since been proven in spades, but the size of that potential was in question. Amex faced relentless competition from a multitude of card issuers led by Visa. Weighing the arguments, I leaned towards sale. Here's where I get lucky. During that month of decision, I played a golf at Protzneck, Maine, with Frank Olson, CEO of Hertz. Frank is a brilliant manager with intimate knowledge of the card business. So from the first tee on, I was quizzing him about the industry. By the time we reached the second green, Frank had convinced me that Amex corporate card was a terrific franchise, and I had decided not to sell. On the back nine, I turned buyer, and in a few months, Berkshire owned 10% of the company. We now have $3 billion gain in our Amex shares, and I naturally feel very grateful to Frank. But George Gillespie, our mutual friend, says that I am confused about where my gratitude should go. After all, he points out it was he who arranged the game and assigned me to Frank's foursome. Quarterly reports to shareholders. In last year's letter, I described the growing costs we incur in mailing quarterly reports and the problems we have encountered in delivering them to street name. Shareholders, I ask for your opinion about the desirability of our continuing print reports, given that we now publish our quarterly and annual communications on the internet at our site, www.berkshirehathaway.com. Relatively few shareholders responded, but it is clear that at least a small number who want the quarterly information have no interest in getting it from the internet. Being a lifelong sufferer from technophobia, I can empathize with this group. The cost of publishing quarterlies, however, continues to balloon, and we have therefore decided to send printed versions only to shareholders who request them. If you wish the quarterlies, please complete the reply card that is bound to this report. In the meantime, be assured that all shareholders will continue to receive the annual report in printed form. Those of you who enjoy the computer should check out our homepage. It contains a large amount of current information about Berkshire and also all of our annual letters since 1977. In addition, our website includes links to the homepages of many Berkshire subsidiaries. On these sites, you can learn more about our subsidiaries' products and, yes, even place orders for them. We're required to file our quarterly information with SEC no later than 45 days after the end of each quarter. One of our goals in posting communications on the internet is to make this material information in full detail and informed unfiltered by the media, simultaneously available to all interested parties at the time when markets are closed. Accordingly, we plan to send our 1998 quarterly information to the SEC on 3 Fridays, May 15, August 14, November 13, and on those nights post the same information on the internet. This procedure will put all of our shareholders, whether they be direct or street name, on equal footing. Similarly, we will post our 1998 annual report on the internet on Saturday, March 13, 1999, and mail it about the same time. Shareholders designated contributions. About 97.7% of all eligible shares participated in Berkshire's 1997 shareholder designated contributions program. Contributions made were $15.4 million and 3,830 charities recipients. A full description of the program appears on pages 52 to 53. Cumulatively, over the 17 years of the program, Berkshire has made contributions of $113.1 million pursuant to the instructions of our shareholders. The rest of the Berkshire giving is done by our subsidiaries, which stick to the philanthropic patterns that prevailed before they were acquired, except that their former owners themselves take on the responsibility for their personal charities. In aggregate, our subsidiaries make contributions of $8.1 million in 1997, including in-kind of donations of $4.4 million. Every year, a few shareholders miss out on our contributions program because they don't have their shares registered in their own names on the prescribed record date, or because they failed to get the designation form back that's within the 60-day period allowed. Charlie and I regret this, but if replies are received late, we have to reject them because we can't make exceptions for some shareholders while refusing to make them for others. To participate in the future programs, you must own Class A shares that are registered in the name of the actual owner, not the nominee name, or broker or bank or depository. Shares known registered on August 31, 1998 will be ineligible for the 1998 program. When you get the contributions form from us, return it promptly so that it does not get put aside or forgotten. The annual meeting. Woodstock Weekend Berkshire will be May 2 to 4 this year. The finale will be the annual meeting, which will begin at 9:30 a.m. on Monday, May 4. Last year, we met at the Exarban Coliseum, and both our staff and the crowd were delighted with the venue. There was only one crisis. The night before the meeting, I lost my voice, thereby fulfilling Charlie's wildest fantasy. He was crushed when I showed up the next morning with my speech restored. Last year, about 7,500 attendees. The meetings represented all 50 states, as well as 16 countries, including Australia, Brazil, Israel, Saudi Arabia, Singapore, and Greece. Taking into account several overflow rooms, we believe that we can handle more than 11,000 people, and that should put us in good shape this year. Even though our shareholders' count has risen significantly, parking is ample at Exarban, acoustics are excellent, and sets are comfortable. The doors will open at 7 a.m. on Monday, and at 8:30 we will again feature the world premiere of a movie epic produced by Mark Hamburg, our CFO. The meeting will last until 3:30 with a short break at noon. This interval will permit the exhausted to leave a notice and allow time for the hardcore to lunch at Exarban's concession stands. Charlie and I enjoy questions from owners, so bring up whatever is on your mind. Berkshire products will again be for sale in the halls outside the meeting room. Last year, not that I pay attention to this sort of thing, we again set sales records, moving 2,500 pounds of See's candy, 1,350 pairs of Dexter shoes, 75,000 of World Books and related publications, and 888 sets of Quick-Cut knives. We also took orders for a new line of apparel featuring a Berkshire logo and sold about 1,000 polo sweat and t-shirts. At this year's meeting, we will unveil our 1998 collection. Geico will again be on hand with both, staffed by Start associates from its regional offices. Find out whether you can save money by shifting your auto insurance to Geico. About 40% of those who check us out learn that savings are possible. The proportion is not 100% because insured differs to their underwriting judgments, with some favoring drivers who live in certain geographical areas and work at certain occupations more than we do. We believe, however, that we more frequently offer the low price than does any other national carrier selling insurance. To all comers, the Geico informational material that companies that support, you will see that in 38 states, we now offer a special discount of as much as 8% to our shareholders. shareholders. We also have applications pending that would extend this discount to drivers in other states. An attachment to the proxy material that is enclosed with this report explains how you can obtain the card you will need for admission to the meeting. We expect a large crowd, so get a plane, hotel, and car reservations promptly. American Express 800-799-6634. We'll be happy to help you with arrangements. As usual, we will have buses to the larger hotels that will take you to and from the meeting, and also deliver you to Nebraska Furniture Mart. Borsheim's in the airport. After its conclusion, you are likely, however, to find a car handy. NFM's main store, located in a 75-acre site about a mile from Axerbin, is open from 10 a.m. to 9 p.m. on weekdays, 10 a.m. to 6 p.m. on Saturdays, and noon to 6 p.m. on Sundays. During the period from May 1 to May 5, shareholders who present NFM with a coupon that will accompany their meeting ticket will be entitled to a discount that is otherwise restricted to its employees. Borsheim's normally is closed on Sunday, but will be open for shareholders from 10 a.m. to 6 p.m. on May 3rd. Last year was our second best shareholder day, exceeded only by 1996. Regard this slippage as an anomaly and hope that you will prove me right this year. Charlie will be available for autographs. He smiles, however, only if the paper he signs is the Borsheim sales ticket. Shareholders who wish to visit on Saturday, 10 a.m. to 5:30 p.m. or on Monday, 10 a.m. to 8 p.m. should be sure to identify themselves with Berkshire owners so that Susan Jocks, Borsheim CAO, can make you specially welcome. Susan, I should add, had a fabulous year in 1997 as a manager. She is everything an owner hopes for. On Sunday afternoon, we will also have a special treat for bridge players in the mall outside of Borsheim's. There, Bob Hammond, a legend of the game for more than 3 decades, will take on all comers. Join in and dazzle Bob with your skill. My favorite steakhouse, Goretz, opened on one Sunday a year for Berkshire shareholders. On the night before the annual meeting last year, the restaurant started serving at 4 p.m. and finished about 1:30 a.m. An endurance trial that was resulted for taking 1,100 reservations versus seating capacity 235. If you make a reservation and can attend, be sure to let Goretz know promptly, since it goes to great effort to help us. We want to reciprocate. You can make reservations beginning on April 1st, but not before by calling 402-551-3733. Last year, I had to leave Goretz a little early because of my voice problem, but this year I plan to leisurely savor every bite of my T-bone and double order of hash browns. After this warm-up, Charlie and I will head for the Dairy Queen on 1114th, just south of Dodge. There are 12 great Dairy Queens in the metropolitan Omaha, but the 114th Street location is the best suited to handle a large crowd that we expect south of the property. There are hundreds of parking spaces on both sides of the street. Also, this Dairy Queen will extend its Sunday's hours to 11 p.m. in order to accommodate our shareholders. The 114th Street operation is now run by two sisters, Connie Burge and Deb Novotny, whose grandfather put up the building in 1962 at what was then the outer edge of the city. Their mother, Jan Noble, took over in 1972, and Coney and Deb continued as third-generation owner-managers. John, Coney, Deb will all be held Sunday evening, and I hope that you meet them. Enjoy one of their hamburgers if you can't get into Goretz, and then around 8 o'clock, join me in having a dusty Sunday for dessert. This item is a part of specialty. The Dairy Queen will furnish you a copy of my recipe and will be offered only in Shareholder Sunday. The Omaha Royals and all Albuquerque Dukes will play baseball on Saturday evening on May 2nd at Rosenblatt Stadium. As usual, your chairman, shamelessly exploiting his 25% ownership of the team, will take the mound. But this year, you will see something new. In past games, much to the bafflement of the crowd, I have shaken off the catcher's first call. He has consistently asked for my sweeping curve, and I have just as regularly resisted. Instead, I have served a pathetic fastball, which is on my best day was clocked at 8 miles per hour with the following wind. There's a story behind my unwillingness to know to throw the curveball. As some of you know, Kenny Cummings invented the curve in 1967 and used it to great effect in the National Association, where he never won less than 28 games in a season. Then to pitch, however, drew immediate criticism from the very highest of authorities, namely Charles Eliot, then president of Harvard University, who declared, "I have heard that this year we at Harvard won the baseball championship because we have a pitcher who has a fine curveball. I am further instructed that the purpose of the curveball is to deliberately deceive the batter. Harvard is not in the business of teaching deception." I'm not making this up. Ever since I learned of President Eliot's moral teachings on this subject, I have scrupulously refrained from using my curve, however devastating its effect might have been on hapless batters. Now, however, it's time for my karma to run over Eliot's dogma and for me to quit holding back, visit the park on Saturday night, and marvel at the majestic arc of my breaking ball. Our proxy statement includes information about obtaining tickets to the game. We will also provide an information packet describing the local hotspots, including, of course, those 12 Dairy Queens. Come to Omaha, the cradle of capitalism, in May and enjoy yourself. February 27, 1998. Warren E. Buffett, Chairman of the Board.